Welcome, everyone. On behalf of the WEFI organizers, Song, Yael, and David, I'd like to welcome everyone to the second lecture of this series. So an overview of the lecture series, we want to present lectures organized by leading researchers in topics in both entrepreneurial finance and innovation, with the goal to provide an overview of important and emerging topics in the field. The goal is to encourage and facilitate more high quality research and hopefully provide some education for PhD students. So this year we had a lineup of 9 speakers. We've got, after Arthur, 7 more and 1 panel discussion, basically every month. In the chat window is a link to the information about the whole series. We look forward to your participation throughout if you can make it. So today, the second lecture speaker is going to be Arthur Korteweg. Arthur is a financial economist at the USC Marshall School of Business, where he holds both the title Dean's Associate Professor of Business Administration and Associate Professor of Finance and Business Economics. His research interests include corporate finance, private equity, and alternative assets. In the private equity research, which will be quite relevant today, Arthur focuses on investment decisions and alternative asset classes, such as VC, leveraged buyout, real estate, and art. I think his papers, Risk and Return Characteristics of VC-backed Entrepreneurial Companies, which was in the RFS, and Risk Adjusting Returns to VC, which was in the JF, are 2 papers in this area that are required reading for anyone interested in these topics. Today, Arthur's going to give us his thoughts on the risk and return of private equity. So before I hand it off, a few notes on the format. So I've got some comments in the chat, but if you have a clarifying question, so if Arthur says something that's super confusing, there's probably someone else who agrees. So either raise your hand in the participant window and Song or myself will evaluate it and try to find a time to interrupt Arthur, or you're welcome to gently interrupt Arthur during the talk if something's confusing. But I want to highlight that Arthur will be around after. The slides will be posted and the video as well. So if there's an in-depth question, feel free to wait around to the end. So with that, Arthur, the floor is yours.
Thank you, Mike, and thank you very much to the organizers for allowing me to speak on a topic that I think is of prime importance. So the game plan for today is to give an overview of risk and return in private equity. So I think the title is quite appropriate here. For those who may not have looked at this literature, so it's going to be kind of a high-level overview of the different approaches, different data sources, different techniques that people have used. It's going to be fairly methodologically heavy, but I'll try to sprinkle in many empirics here and there to illustrate what kind of results people have found to date. Okay. So I have a lot of slides, so this will be a little bit like drinking from the fire hose, I suppose. So as Mike said, I'm more than happy to address any clarification questions, but anything more in depth we'll handle at the end of the talk, and I'll stick around. So why do I think this is an important issue? If you look at allocations to private equity over the last 20-odd years, you'll see across the board that many institutional investors have increased their allocations quite dramatically. So this picture here shows US public pension plans, how much of their portfolio has been allocated to private equity. And you can draw a similar picture for endowments and other investors, and you see that these allocations have gone up quite dramatically over time. If you look at endowments, many of them are comfortably in the double digits by now. Now, when I talk about private equity, sometimes people mean just leveraged buyout. I'm going to use private equity in the broadest sense of the word, encompassing not just buyout, but also venture capital, real estate, infrastructure, other forms of essentially equity that is private. Now, why is this such an important issue? Well, returns, of course, are going to be important, particularly if you put a high allocation of your portfolio into PE. But risk also becomes important when allocations go from very small digits to significant numbers. Okay? So when you have only a tiny fraction of your portfolio in a particular asset, perhaps you're effectively risk neutral towards this asset, you just care about average returns. Once you start to allocate large amounts, risk becomes first order important. Now, this is not just important from an academic perspective. Clearly, this has many practical implications as well. And private equity generally is in the news almost on a daily basis. Whether it is about the returns, how they are measured, whether fees are correctly accounted for, whether private equity should belong in defined contribution plans, which is something that's being actively talked about now, whether 401ks should be allowed to invest in private equity, etc. Now, I'm going to dive in from a general asset pricing angle here, because we have a big toolkit to think about risk and return that's been developed over the last number of decades, which is basically looking at either Sharpe ratios when we think about large portfolios of assets. So if we think about a well-diversified portfolio, if we measure the Sharpe ratio of that portfolio, meaning the ratio of the expected return, expected excess return on that portfolio relative to its volatility, that is a good measure of the risk and return trade-off, right? For each unit of volatility, how much do you get in expected return, and a higher Sharpe ratio would be better. When we go to individual securities, that Sharpe ratio doesn't work quite as well because much risk is what we call diversifiable. So we really care about systematic risk, and risk is really defined as the co-movement of the returns on a security with a set of risk factors. And investors should be compensated for bearing exposure to these risk factors, and particularly bearing exposure to undiversifiable or systematic risk. So I'm sure I'm not telling you anything new here. The usual way we approach this risk and co-movement issue is through a factor type model, where we regress the excess returns on the security on the left-hand side on a set of risk factors, which are in the vector F here. And then we get a set of risk loadings, which are the betas that tell you how exposed you are to these different risk factors. And then there's an alpha, which tells you what is the risk adjusted return, how much is left after you take out the compensation for risk to the investor. And that's basically kind of gravy, right? That's the excess return that you earn over and above what you should be earning based on the amount of risk that you're exposed to. Okay, so this is the standard toolkit that I'm sure we are all very well familiar with. And the first question that comes to mind is, well, why don't we just copy paste these kind of techniques to private equity? Right? There's no reason to reinvent the wheel. So why don't we just do that? The short answer to that question is the institutional setting of PE. So let me take a minute or two to just go over the bare basics of how the PE industry works for those of you who have no familiarity with this. For those of you who know this industry in and out, you can get a coffee for 2 minutes and come back, and then we'll get into the meat of things. So how does this industry work? Private equity firms such as firms like KKR or Blackstone or Sequoia, that I'm sure you've heard about or read about at one time or another, they raise funds. These funds are organized legally as limited partnerships with a limited lifetime. Typically 10 years, could be extended for a couple of years in many cases, but they're supposed to have a finite life, after which the fund gets liquidated and all money gets distributed to its investors. The investors that put up the money are called limited partners, or LPs. These are typically your pension funds, endowments, insurance companies, wealthy individuals, sovereign wealth funds, family firms, etc. Their only job is essentially to put up money. Okay? So they are responsible for the bulk of the capital. And the PE firm's partners are the general partners or GPs in the fund, and they do all the work in terms of finding deals, managing the portfolio investments, so serving on the board of startups if we're talking about a venture capital fund, for example, providing advice. These are very active investors, and they may help out in various ways with trying to create value for the investments of the fund. And ultimately then arranging exits in terms of either an initial public offering or a merger and acquisition by, say, a strategic acquirer, after which the money gets distributed to the limited partners after fees. Okay, so the fund, the PE fund, is a portfolio of investments. The key difference between the different, I'll call them asset classes, we can quibble about whether you should call them that or not, but the different asset classes within PE, like venture, buyout, real estate, is really the type of portfolio investments that they make. So when we think about VC, we think about startup companies. Buyout is about companies that are perhaps struggling. They may have been around for a long time, could be like a Burger King or so, but need to be turned around. They may need an external investor to inject some new money. Could be growth companies. Real estate tends to be commercial properties, et cetera, et cetera. Now, the way that these funds work in terms of the cash flows is that not all the money gets initially transferred to the fund at the time of fundraising. Rather, the GPs, the managers in charge of the fund, call capital from the LPs when they find a deal to invest in. Okay, so that capital gets called over time from the LPs. When a portfolio investment exits, when it gets sold or has an IPO, any money that comes back to the fund then gets passed through to the LPs. So there are some limited occasions where the GPs can recycle capital, but we'll abstract away from that. Typically, it's a pass-through of any money that comes in from an exit after fees. Now, the typical fees to the GP are a management fee. So this is a fixed, usually 1% to 2% per year fee. So over the lifetime of a fund, if we talk about a 10-year fund, this could amount to 10 to 20% of the capital of the fund that gets soaked up by management fee. The median is about 15% over the life of the fund. And the other common fee is carried interest. So this is a profit share that goes to the GP, typically 20 to 25% of any profit that's generated. There's other fees, particularly in buyout. There's management service agreements, and there's basically advisory fees that get charged to the portfolio company. Ludo Falipu has a nice paper on this in buyout specifically that details in very high detail what these fees exactly look like. I'm gonna not spend too much time on this for the purpose of this talk. Now, the other thing that's important for our purposes is that the GPs send quarterly reports to the LPs with respect to the status of the fund, and most importantly, for our purposes, a net asset value of the fund. So some sense of what is the value of the portfolio companies that the fund has invested in at that point in time. Okay. Now, to give you a brief, very short impression of what these funds might look like in terms of size and how many of them are there. This is data from a company called Preqin. They do Freedom of Information Act requests. That's how they get most of their data from public entities, such as public pension funds that have invested in PE and basically say, give us your PE data. And so they have data on all kinds of different private equity funds. This data goes from 1969 to 2019. This industry really didn't take off till the early 80s. So you see that there's very few funds before 1980, and it really didn't become material till probably the early 1990s. So most of the data is from the 1990s and the 2000s. So here you have a short impression. I'm not going to belabor this slide. I'll leave it up to give you a short impression about the number of funds that have been raised to date in VC, buyout, real estate, these different classes of private equity, how many GPs there are in this data source to date, average fund size, median fund size, and how many of these funds have actually been liquidated. Getting back to the cash flows then, as I mentioned, the capital for a fund gets called up over time, and then the distributions come back to the limited partners, to the investors over time. So if you look on average across funds, this is more or less what that looks like. Scaling everything to a $10 million commitment. So you're a pension fund, you've committed $10 million to your average, say, VC fund. On average, you see capital and over the first 5 years of the fund. These are negative numbers because this is from the LPs, from the investor's perspective. So any capital call is a cash outflow from your perspective. So you see that the $10 million gets called in on average over the first 5 or 6 years. There's some variation around that. The shaded area is the 95% bound across different funds. So some funds call capital faster, some call slower, depending on how much deal flow they have, whether there's a lot of deals happening at that point in time anyway. And then distributions come in somewhat slower, right? They tend to come in only after 3 or 4 years when some of these portfolio investments have matured enough to have an exit. And then the bulk of the distributions get realized towards the latter half of the fund life. Okay? And you see that the pattern is somewhat similar across all the different classes with some minor differences. But importantly, as is noted here, these are cash flows after fees, right? So these are after the profit shares taken out by the GP, after the management fee, etc. So these are the cash flows that you would observe as a limited partner in the fund. For a particular fund, it's not going to look quite as smooth. So this is a fictitious fund, so I just made this up, but I think it's fairly representative. You get a bunch of capital calls at random times initially, and then you get distributions later down the line, again at random times whenever these portfolio companies get sold. Okay, so that's a very quick, broad overview of the kind of data that we're looking at the fund level. I'm going to spend most of my time today at the fund level, in part because of time constraints, and in part because this is where the bulk of the literature has been. But towards the end, hopefully I'll have some time to talk a little bit about other data sets that are out there, particularly investment level data. All right, so now once we have this, we can think about constructing returns. So we have cash flows that we observe for the fund, and we have net asset values, which gives some impression of the value that's in the fund. So you could think of constructing a quarterly return, since we get quarterly reports, we get quarterly net asset values of the fund, by just looking at what is the beginning net asset value of the fund, what is the ending net asset value of the fund for a particular quarter, and what were the net cash flows of the fund over that quarter. Okay, so this is very similar to saying a return is the end of period price plus dividends relative to beginning of period price, like we would construct for any kind of other security. The one difference, or the two differences are, we're talking about net asset values here, which are valued by the fund. So I will get back to this in a couple of slides. But they might not be quite the same as market prices. And we're talking about net cash flows here. So net cash flows I define as distributions minus capital calls. So they could be positive, they could be negative. So you can think of capital calls as an equity issuance by a company when you contribute money to the company. You can think of distributions as dividends. That's kind of the analogy that you can bear in mind here to constructing returns. Now you lose the first quarter for any fund because you start at a net asset value, NAV of 0, so you can't divide by 0. So you can't really construct this return for the very first quarter, but conceivably you can do this for all the future quarters of the fund. Also note, particularly when we start thinking about the cross-section of funds, not all funds report at the end of a calendar quarter. Many of them do, but others may report in February, May, August, November, or January, April, et cetera, et cetera. So they might not be quite aligned in time, which if you were to run regressions in the cross-section, you should take that into account, that they may not be quite reporting all at the same time. Alternatively, you can think of just aggregating all these returns and thinking of a return at the industry or asset class level. Like, what is a VC return over the last quarter? Which is essentially just NAV weighting all the individual fund returns using their beginning of quarter net asset values relative to the aggregate. And you can work this out. I'm not going to belabor this. But basically, you just add up all the NAVs and use the aggregate end of quarter NAV, the aggregate cash flows over the quarter relative to the beginning of quarter aggregate net asset value. So you can construct this. There's actually a company out there called Cambridge Associates, which publishes a quarterly return to private equity. So I graphed here their reported VC, US VC returns, and US buyout returns. I think what they do is pretty much this quarterly aggregate return, but they're a little short on detail. So I'm not quite sure whether that's right. I did replicate these returns using Burgess data. So Burgess is another company, somewhat like Cambridge Associates. They provide advisory services and some portfolio management services to players in the industry. So that's why they see a lot of the funds that are out there. So Burgess data you can get access to if you, as a researcher, if you file out a research proposal, and every once in a while they'll evaluate these, and hopefully you get approved, you can get access to this. So this is data that in principle is accessible to researchers free of charge if you fill out an application essentially. So I constructed these quarterly returns for Burgess for US buyout for much of the same period. I get about an 86% correlation between the returns, given that they don't quite see the same funds. I think that suggests that Cambridge Associates returns are essentially doing the same thing. Either way, so this is a small impression of what these returns look like. You might not be surprised that venture capital returns look amazingly large in the late 1990s. This is the tech boom. Then we had the internet crash in 2001, and returns didn't look quite that great. There's of course the Great Recession in 2008 and COVID happening in early 2020. So that gives you some impression of what these returns might look like. Now, if this was all there is, we could take these returns, regress them on quarterly factor returns, and we get some loadings, we get some factor loadings, and we would be in business. Unfortunately, there are some concerns with using net asset values. One concern is that many of these NAVs might be stale, that these might not be the current market values of the portfolio companies as of the period at which they are reported. So they are supposed to be marked to market, particularly since FAS 157, which is, I think, now renamed to Accounting Standards Code Topic 820. They're supposed to be marked to market, but these are what are called level 3 assets. There really isn't much of a market to mark to. So lots of funds still keep investments at book value are kind of slow to mark them up, and these prices might be somewhat stale. So if we talk about, say, venture capital, many of these portfolio companies might still be marked at the post-money valuation of their most recent financing round, which may be months ago or even longer. So they may be stale in that sense. And the problem with staleness is that it induces certain issues with volatilities and covariances and autocorrelation in returns that kind of muck up our estimates of risk and return. Okay, so one thing that happens is that volatility in these stale indices tends to be downward biased, much more so than it doesn't affect expected or average returns quite that much. So if you compute Sharpe ratios, the ratio of an expected return over a vol, if the volatility is downward biased, then upward biases the Sharpe ratio. So if you compute the Sharpe ratio on, say, the raw Cambridge Associates data, it looks quite impressive, but that might not be the correct Sharpe ratio that you should be using. It also induces a downward bias in factor loading. So your betas that you would estimate would be too low, which in turn results in an upward bias in the alpha. And it induces autocorrelation in returns. Okay, so I computed the autocorrelation at various lags from the Cambridge Associates data. And you see that there's quite high autocorrelations, particularly at the 1 quarter lag, and then they kind of diminish over time as you go to further lag. So when you go about a year back, these autocorrelations tend to go close to 0. But clearly in the time span of a year, there's quite significant autocorrelation in these returns. Compare that to public equities, there's very little autocorrelation, right? And if you think about efficient market hypotheses and things like that, you would expect there to be little autocorrelation. So this may be a sign that there is some of this staleness happening. There may be other reasons why there's autocorrelation, but staleness certainly would be one prime suspect. Other than staleness, there's some other concerns with NAVs. Maybe these NAVs could be manipulated in some sense. If you're an underperforming manager, you don't have a long track record to show your potential future investors, and you're trying to raise your next fund, you might be tempted to bump up some of your net asset values because it makes your current metrics look a bit better. And there's some evidence to that extent. Many GPs also tend to be, particularly the ones with a good reputation, they tend to be conservative. They tend to be slow to mark up valuations and more aggressive in marking down valuations. And maybe you like that as an LP. Maybe there is something to say for being conservative. But for the purpose of measuring risk and return, that's not great. Right? That mucks up these estimates of risk and return. There's some issue with fees. The fund cash flows, as we saw a couple slides ago, are net of fees. Net asset values are essentially reported pre-fee. It's just the valuation of the company, like the post-money valuation of a startup in venture capital. They don't take into account some kind of expectation of what carried interest, what profit share might be paid out on that particular startup. So these are essentially pre-fee valuations. So if you compute returns from the NAVs and the cash flows, you get some kind of awkward mix of pre and post fee numbers that I'm not quite sure how to interpret. And particularly for VC, since this is an entrepreneurial workshop, at the end of the day, I'm going to talk a bit more about venture capital. Post-money valuations tend to be not equal to actual third-party arm's length market values. There's a paper by Metric and Yasuda that looks at this. Paper by Wilgonal and Elias Strabalayev that has a lot of details on this stuff that you can look at. Okay, now given all these issues, what do you do? How do you get around this? Well, one suggestion is to use longer horizon returns. Let's just use annual returns. Maybe some of these issues go away. Problem with that is, well, if we had an infinitely long time series, that'd be great. But this industry really hasn't been around for more than 30 years. So 30 years of annual returns to measure average returns and to measure covariances and variances isn't great, right? If you compare it to public equities where we can use monthly returns, right? Higher frequencies are better for measuring variances and covariances. So if you have monthly returns over a longer horizon, going back to the 1920s or maybe even further back, you can get much better estimates. Using 30 years of annual returns isn't great. So longer horizon returns where we are right now isn't a great solution. Maybe 100 years from now that will help us, but right now we kind of have to work with what we've got. The other 5 that I have on here, I'll talk a little bit more about, but I'm going to try and go through this fairly quickly in the interest of time. So one thing you could do is imputing net asset values and say, well, rather than using the net asset values that are reported, let's come up with our own. So there's a paper by Paul Gompers and Josh Lerner back in 1997, where they impute the value of each portfolio company of the data that they have, which is coming from Warburg Pincus, which was predominantly VC investments at the time, is my understanding. And they update the company's valuation from the most recently observed financing round using returns to publicly traded firms in the same 3-digit SIC industry. So if you think that those are good proxies for the return on the private companies, that is a very valid way to go. Of course, you can put question marks behind whether those are really the right proxies, whether they approximate the returns to the startups well. The other problem with this is that this doesn't work so great for most commercial fund data sets because they don't give you portfolio company information. And to do this kind of approach, you need portfolio company information. Another way to try to fill in net asset values is by filtering. So there's a nowcasting paper, which is essentially using a state space model where we say unobserved valuations are like the latent state in this model. And once every so often we observe a valuation. And then we can filter out all the unobserved valuations. So that's what they do. They actually get weekly net asset values. And they estimate a venture capital beta of about 1.3, just to give you a sense of what kind of betas people estimate. This would be just a CAPM market beta. So there's only one risk factor here. And they estimate a buyout beta of 1.1. One nice thing about this paper is they can get fund level alpha and beta estimates, which most papers do not. So that's kind of a nice side benefit from this approach. Other ways you can deal with these issues is use some of the real estate techniques where people have wrestled with the stale price problems for a long time. There's also some hedge fund literature that looks at return smoothing, which is a very related kind of issue. And there's some statistical methods to unsmooth the index, going back all the way till the early 90s. And there's some more recent papers that use various techniques to do this as well. So this is having a little bit of a revival very recently. And this seems to matter. So if you look at the basic raw volatility on the Cambridge Associates buyout index, over the last 15 years, that's about 4.7%. The unsmoothed version gives you a vol that's about 50% higher, 6.4%. Right? So this smoothing really seems to matter for volatilities. I think one of the drawbacks is this tends to rely on an econometric specification of what is the observed process of returns that typically doesn't have a strong micro foundation and can be quite sensitive to these econometric modeling assumptions. But it certainly illustrates that this kind of unsmoothing business matters. Other techniques are Dimson Betas. So Dimson has a JFE paper back in 1979 that deals with asynchronous prices, which is basically what we're dealing with when we're talking about stale prices. And his solution is to add lagged returns to the risk factors to your factor model. So instead of just having the contemporaneous market return in your CAPM regression or your Fama-French regression, whatever it may be, you also add a 1 quarter lag, a 2 quarter lag, a 3 quarter lag, however many lags you want to add. And then the sort of true beta estimate that accounts for the staleness is simply the sum of the beta estimates of all those lags. So the contemporaneous estimate plus all the lags. More generally, Dimson also suggests adding leads of the market factor, but that's only if the risk factors are in fact stale themselves, which, for all intents and purposes, the ones we typically use are not. So there's no need to include leads of the risk factors in most cases. So there's a few papers that do this. I'll lift out one particular example, which is Ewens, Jones, and Rhodes-Kropf, which is a 2013 RFS paper, where, let's take VC funds, they have a contemporaneous beta estimate of 0.4, right? So if you ignored the lags, you would say, oh, VC is really not that risky. It has a 0.4 beta. But once you take into account all the lags and add up these coefficients, you end up with a beta estimate of 1.2. Okay? And you can do something similar for buyouts, etc. Then the final approach I'm going to talk about here is using secondary market prices, because there is a market in LP fund stakes. So instead of using net asset values, which are valuations reported by the GPs, why don't we use transactions of LP fund stakes from one LP to another? Right? These should be actual market prices, right? Negotiated between two separate entities. So this should give a much better indication, in theory, as to what is the market value of the portfolio at that point in time. So I think this is a very promising way of trying to deal with many of the problems, if not all of the problems that we have with these NAV-based returns. At the same time, this market is still very illiquid. It's been growing quite dramatically. But it is still very illiquid. It can take 3 to 6 months to do a transaction. You have to have GP approval in most cases. So transaction costs are quite high. So there are still some drawbacks to using this approach. Okay. Putting all this together with some, I guess, academic liberty, we can quibble about some of these check marks, but this is my sort of broad overview of which of these methods deal with which of these various issues with net asset values. As I mentioned, I think secondary market prices are most promising, but it's not a panacea. Most of the other methods were really devised to deal with still prices, not so much with the other issues that we're looking at. So, okay, where does that leave us? That leaves us with maybe using some alternatives that avoid NAVs as much as possible and really just look as much as we can at just cash flows. And that's in fact what most of the popular methods that are out there to assess at least return, if not risk, in fact do. So the most popular methods that are used in practice are what's called the TVPI, or total value to paid in capital, which is really just a cash multiple, and the internal rate of return, which should be familiar to anybody who's ever opened a corporate finance textbook. So these are very standard metrics. The TVPI is officially defined as the sum of all distributions to the LP. So this is really looking at the LP perspective, the, say, pension fund or endowment perspective. It's a sum of all the cash you got in, all the cash you received from the fund relative to all the cash that you put into the fund, all the capital calls. So in that sense, it's a cash on cash multiple. For liquidation, for a liquidated fund that's all done and liquidated, etc., it's purely based on cash flows. For funds that are still live, that are still active, that are not yet liquidated, typically people include the final reported net asset value to recognize that there's still value left in the fund. We have to account for that somehow. Okay, let's use the net asset value for that. But it only uses that very final net asset value, right? Rather than quarterly net asset values to construct quarterly returns. Similarly, for the internal rate of return, it's just the IRR. It's the discount rate that makes the fund NPV equal to 0. So what is the discount rate such that if we discount all the net cash flows to the LP back to fund inception, that makes the NPV equal to 0. Okay. Again, for a fully liquidated fund, that's purely based on cash flows. For a still active fund, we, like we do in the TVPI, typically include the final reported NAV as sort of a pseudo distribution. So it still uses NAVs, but as little as we can. So these are the most common metrics used in practice. So this is just one example. It's a survey done by Paul Gompers, Will Grinnell, Steve Kaplan, and Ilya Strabelayev. Has a lot of really useful and interesting tidbits about what venture capitalists do. You can do this for buyouts, I'm sure it's similar answers. They primarily use the cash on cash multiple, which is TVPI, and the IRR, net of fees. So based on the net cash flows. Now, just to give you a brief impression of what these look like, this is the distribution of fund TVPIs for the different private equity classes, venture capital, buyout, real estate, etc., for vintages, funds raised between 1969 and 2014, right? So the 2014 vintage would be all funds raised in 2014, 2013 vintage would be all funds raised in 2013, etc. So this data is all funds raised between 1969 and 2014. Some of these will be liquidated, some of these will still be active, because, for example, the 2014 ones have only been active for 6 years, so they won't have been liquidated yet. But this to give you an impression what these TVPIs look like. Most of them, the modal TVPI is somewhere in the range of 1.25 to 1.75. So cash on cash multiple. It tends to be a bit higher for buyout. It tends to be very spread out for VC and quite skewed, right? But this gives you some initial impression of what the data looks like at the fund level. Similarly for IRRs, most IRRs are in the range of somewhere of 8% to maybe 15% per year. Little bit higher for buyout, a little bit more spread out for venture capital, etc. So I'm not gonna spend too much time on this, but I'll leave this in the slides for your perusal. Now there's some issues with these measures, so just take any corporate finance textbook and look up money multiples and IRRs, and you can basically check every box here. So TVPI ignores the timing of cash flows. $1 today is just as good as $1 10 years from now. IRR does account for the timing of cash flows, but it doesn't always exist. You can have multipliers. It can be sensitive to moving the timing of cash flows, and to the extent that GPs have some way of moving these cash flows around, that might give you some concerns, particularly with the use of credit lines nowadays for funds. There's a paper by Albertus and Dennis that looks at this in more detail. There may be some concerns that these IRRs and TVPIs can be manipulated to some extent, and just the fact that leverage increases risk, increases expected returns might have some effect here. Portfolio IRR is not the weighted average of constituent IRRs. You have to be a little bit careful when you take averages of IRRs, and that's not really representing any particular portfolio. And of course, there's the reinvestment assumption that's typical in IRRs. Some people also run regressions with IRRs on the left-hand side and say, well, we have IRRs, why don't we regress those on factor returns over the life of the fund? From my playing around with this a little bit, they don't seem to give you unbiased estimates. So then on the right-hand side, you probably want to use a money-weighted return as well, rather than just the average return on, say, the market over the lifetime of the fund. Use, say, a pseudo fund that invests in the market at the same time with the same quantities as the private equity fund to run these regressions. But even those don't seem to be quite unbiased. At the same time, I haven't seen anybody kind of get into the econometrics of such regressions. So that would be something interesting to explore. But generally speaking, these don't seem to give you unbiased estimates. Now, of course, the biggest issue I haven't put on this slide, which is the fact that both TVPI and IRR don't account for risk. And these are pure average return kind of measures. They don't account for risk. So that's where we end up with what's called the public market equivalent, which has gained a lot of attention also in industry in the last couple of years. More and more GPs start to report this measure as one of their standard metrics because it does start to account for risk. So this goes back all the way to a paper by Long and Nichols back in 1996. It was popularized and redefined by Kaplan and Shore in 2005. So that's sort of the seminal, I think we can call it seminal paper by now, that introduces the PME into the academic literature. That basically everybody cites when they talk about PME. So what is PME? It's essentially a discounted TVPI. It's a discounted money multiple, computed as taking all the distributions of the fund and discounting those back to fund inception by the public equity market return, say the S&P 500, and then summing up all those discounted distributions and divide them by the sum of the discounted capital calls. Okay, so it's very much a discounted TVPI. And the common interpretation then is that it benchmarks private equity against the public equity market. So if the PME is equal to 1, then the interpretation is private equity returns have performed equally well as the public equity market. If it's above 1, private equity outperformed. If it's below 1, private equity underperformed. Okay. Most papers use the S&P 500 as a benchmark, but you can pick whichever index or benchmark you want to use. So common alternatives for VC are to use the NASDAQ or the Russell 2000. That gets a bit closer to the type of companies that venture capital invests in. You could use a value portfolio, growth portfolio. You could use different kind of returns here. But most papers end up using the S&P 500 or one of the other ones for VC. Now, what does that look like in the data? So here's a paper by Bob Harris, Tim Jenkinson, and Steve Kaplan. That's a great paper for getting an overview and an impression of this data, because they look at different data sources that are out there, and they give you a lot of interesting stats on what these metrics look like. So this is a great paper to read freely. You see that for buyout across most vintages, this PME is somewhere in the range of 1.2 to 1.5. So it's above 1. There's a little dip here in the financial crisis, but in the vintages post-crisis, it tends to be just above 1. You see across most data sources, they get fairly similar results. So pre-Quinn, the results tend to be in the same ballpark. Cambridge Associates tends to be somewhat in the same ballpark. Venture economics, VE, tends to be somewhat lower. So they seem to miss out some of the higher yielding buyout funds. Venture capital looks quite a bit different. Venture capital looks really attractive in the mid to late 90s, basically until the 1998 vintage. These are all the funds that ended up investing and cashing out in the internet tech boom in the late 90s, right? Take a 1993 vintage fund. They invested in their portfolio companies in the range of 93 to 95 or 96. Many of these companies got out in the late 90s and at very high valuations. So these funds did very, very well. The funds that were raised in 1999 and beyond tend to have PMEs below 1, at least on average. Okay, so the average VC fund post 2000 doesn't look quite as attractive relative to the public equity market. And you can see again the differences across the various data sources. There's some sense in which Preqin might miss out on some of the top VC funds because those tend to not take public money and therefore are not, their data isn't subject to FOIA requests. But over and all, post 2000, these data sources look fairly similar. Okay, let me get back to methodology here. And let me take a little bit of a segue, and this is going to come a little bit out of left field, but I'm going to tie this back to PME in a second, well, in a minute. But let me talk a little bit about a somewhat different view on risk and return from a methodological perspective. That's going to end up being quite closely related to factor models, and that's using stochastic discount factors or SDFs. So you can compute the value of a security, let's call it V at time t, and the security only has one cash flow. It only has one payoff at time t+1, next period, and I'll call that cash flow C at t+1. The value of that cash flow depends on how much the investor values getting a payoff at that point in time. Right, which kind of depends on the state of the economy, how well their portfolio might be doing at that point in time. And that is captured by this, what is essentially a random variable called capital M t+1. This is your stochastic discount factor. And I'm going to use a very specific specification for the purpose of this talk for the SDF, which is an exponential affine stochastic discount factor. It's an exponential. In the market return. Okay, so this says the A and B here are parameters that you could estimate or you could fix if you want to. They would typically be positive numbers, and the market return is just the return on the market. So this would say that if B is a positive number, if the market did really, really well, so you did very well on sort of your public investments, this SDF would be fairly low, which basically means that you wouldn't value getting an extra dollar as much at this point in time because, well, you feel pretty rich already because the market did very well. If the sort of aggregate economy captured by the market didn't do so well, if this was a negative return, you would very much value getting additional dollars, right? You really would like having an additional payoff at that point in time because you're bleeding money in your portfolio. So you would really be very happy getting an additional cash flow, and the SDF would be high. Okay, so it's sort of like state prices, essentially. You can think of it that way. So then the value of this particular security that just pays off at time t+1 depends on, well, does it pay off? Does it tend to pay off when times are good or times are bad? Does it tend to pay off when the SDF is high or low? And that's going to drive the present value of the security. Okay. What's nice about this exponential affine SDF is that it extends very easily to multiple horizon cash flows, so multi-period cash flows, because it compounds over time. SDFs compound over time. That's theoretically true. The exponential affine function of this remains an exponential affine. All that changes is that you use the market return over the horizon of the payoff. So a 5-period payoff, the SDF over that period would simply use the 5-period market return with the same A and B parameters. So it's a very nice specification to use for multi-period cash flows, which of course, when we think about private equity funds, we're talking about 10-year or even longer horizons where cash flows happen at various times in that horizon. And this kind of specification is quite attractive to work with. You can also motivate this from theory. If you say, let's pick A equal to 0 and B equals to 1, this SDF is just 1 over the market return, which is essentially a log utility investor. So an investor who invests in the market and has log utility would have this SDF. You could have a power utility investor by keeping A at 0, but making B the coefficient of relative risk aversion, your gamma in your CRRA, power utility function, et cetera, et cetera. You can add additional factors to this by making RM a vector of factors, et cetera, et cetera. So this has some attractive properties. The other nice thing about this exponential affine SDF is this, it has a fairly close relation to factor models. So if you make one additional assumption that returns are log normal, then this exponential affine SDF is equivalent to what I'll call a log CAPM. So it's the CAPM in log returns. So the excess log return on a security is just its beta times the excess log market return, okay? Where the beta is defined in the usual way. So you can think of using this exponential affine SDF as a benchmarking interpretation. If this SDF is correct, then you would be able to replicate a securities return by a levered investment in the benchmark portfolios, where the benchmark here is just the market return, right? If you have a multi-factor exponential affine SDF, then the benchmark portfolios would be those factors that you stick into the SDF. One advantage of using the stochastic discount factor valuation approach relative to the log CAPM is that it doesn't require this log normality assumption. So it's a bit more general, which is important, particularly if you think about venture capital, because there's a lot of skewness in the returns. Okay, so if you look at the portfolio of a particular VC, you typically find that most of the money gets invested in portfolio companies, startups that end up returning less than a one-on-one multiple, so less than the money invested. And then there's a few very far outliers on the right-hand side where you didn't invest quite as much money, but you got a very high multiple, right? And this also translates to the industry at large. The prior slide was for one particular fund. If you look across the industry, there's a post by Correlation Ventures where they look at a broad data set. You see that most of the money gets invested in startups that get a 0 to 1 multiple, so they earn less than the money invested. And then there's some far out of the ballpark home runs that happen once every so often. So these returns are going to be very, very skewed, much more so than a log normal distribution. And so it's important to not get too constrained by this log normality assumption. Okay, so let me tie this back to PME before I go far off on a tangent. And let's slightly redefine the PME, not as a discounted ratio of distributions to capital calls, but simply as essentially an NPV type calculation, the sum of discounted cash flows, where each cash flow is simply the net cash flow as defined before the distributions minus the capital calls at any point in time. So you take the series of net cash flows that you see in the fund, discount all of them back to fund inception using the market return, and then add them all up. This is a somewhat better behaved definition than the ratio of discounted distributions to calls. It's better behaved econometrically. You avoid some issues with Jensen inequality and such. And it's kind of a nice sort of NPV analog to a fund. Okay, so now the benchmark is going to be 0, essentially. Right? So if the PME is 0, then, and this is the right discount rate, if this is the right SDF, then you would get an expected PME of 0. If it's above 0, then you would love to invest in this fund. If it's below 0, you would not. Okay. And if you then compare this to the SDF valuation approach from a couple slides back, it becomes pretty clear that essentially what we're doing here is the SDF kind of valuation, basically computing the NPV of the fund using 1 over the market return as the stochastic discount factor. Okay, so this is really just applying SDF pricing with the SDF equal to 1 over the market, which is the SDF that a log utility investor would have. Okay, so you're basically presuming log utility of investors. Now, this is important because it gets into some hairy issues with how you interpret the PME. So a common interpretation is that the PME assumes that the beta is equal to 1 because you're using just the market return, which by definition, the market has a beta of 1. And then if truly the beta is above 1 and we're using PME, then the common interpretation is that PME will overstate the risk-adjusted return. It will make it seem as if the fund has a higher risk-adjusted return than it really does, because the discount rate should have been higher because the true beta is above 1, but we were kind of working with a beta assumption of 1. Now this isn't true. It's true that PME works correctly if the beta is equal to 1. It's not true necessarily that PME will overstate the risk-adjusted return if the true beta is above 1. It may or it may not, depending on the circumstance. And the reason is that, well, PME doesn't really assume that beta equals to 1. If you take this SDF kind of pricing perspective, cash flows are simply valued at their state prices, and those state prices reflect risk. Or in other words, risk is really just measured by the covariance of the returns with the stochastic discount factor, which the SDF approach takes into account. If something has a very high correlation with SDFs, meaning the fund pays off when the SDF is very high, that would be a very attractive, not risky kind of investment. If the correlation with the SDF was negative, then it would be a risky investment. That's taken into account by this approach. So funds can have different betas. There's really no presumption that a beta is any particular value. What it does do is it restricts, because it restricts the parameters in this more general exponential affine SDF, it restricts the risk-free rate and the market premium that are implied by the PME. And it turns out that for beta equals 1, these restrictions don't matter. They tend to kind of cancel each other out. But if beta is not equal to 1, this is important. So in the interest of time, I'm going to go a little bit quicker here. But at some point, I constructed an example here from data for various decades going back to the 1960s. So what this shows is the risk-free rate over the decade, the average market return, the market volatility over the decade, and the PME implied risk-free rate and market premium. And you see that those are tend to be quite different. So it doesn't match the sort of empirical risk-free rate and market premium quite so well. And it turns out that if beta is equal to 1 for any investment, that doesn't really matter, because once you add up the risk-free rate and the market premium, you correctly recover the market return over the decades. So whether you use the PME or the more unrestricted log CAPM gives you the same benchmark return. But if the beta is above 1, this can make a difference. So typically, if the beta is above 1, you get the common sort of assumed result that the PME kind of understates the benchmark return that you should be hitting on the investment. So for example, in the 1990s, if you had a beta equal to investment, the PME says, oh, your benchmark return is 19.4%, so you should be hitting 19.4% a year. But the more general log CAPM says, well, you really should have been hitting 30% because, well, the market did pretty well over that period. And there's a fairly significant market premium. But that's not necessarily true all the time. If you look at the 1970s, the PME, in fact, overstates the benchmark return and says, if you had a beta equal to investment, you should have been hitting a 10.2% return. But really, truly, if you buy the log CAPM, the more general model, you should have only been hitting 8.5%. So in this period, using the PME would kind of understate the risk-adjusted return rather than overstate. So bottom line result is it really depends on not so much whether beta is above or below 1, but what are these restrictions on the risk-free rate and the market premium that PME implies, whether it over or understates what the true risk-adjusted return on an investment truly was. Okay. All right. So let me move on. So I have a paper with Stefan Nagel from a couple of years ago where we say, okay, well, we don't have to impose this 1/RM discount rate for the PME. Let's generalize that and let's use this exponential affine SDF. We can estimate the A and B. It could be that they end up being 0 and 1 and we're back to the PME world, and that's fine. Or it could end up that they're different. And then we can apply this more general PME method. So that's what we did. What we found was that if you use the traditional PME, so we looked at venture capital funds, the traditional PME, in our sort of redefinition, where we just discount all the cash flows back to time 0. So the benchmark number, or sort of the threshold number you're looking for, is 0, 0 NPV essentially. If you use the log utility PME kind of model, you find a PME of 0.05. So the way to interpret that is on a $1 commitment, the NPV of your average VC fund was 5 cents. So you would earn 5 cents in NPV over the lifetime of the fund. But that's, of course, restricting these SDF parameters to 0 and 1. If you generalize that, if you actually estimate these parameters, we get an estimate of particularly the loading on the market here that's above 1. So if you want to give this a power utility kind of interpretation, it would have a coefficient of relative risk aversion of about 2.7. The A is slightly above 0. If you apply this more general model, you actually find that the average VC fund actually had a negative NPV of about 10 cents. Okay, that seems to be concentrated in the post-2000 period. If you look at funds before 1998, it still gives you a positive estimated generalized PME, although that's not significantly different from 0. But the difference here is strongest in the post-2000 period. All right, now, of course, you can use other SDFs. You can use Farmer-French, you can use 5-factor models. One paper that I would like to highlight is by Gretel Sorensen-Waller. They use some consumption CAPM SDFs, and it looks like external habit formation, long-run risk models. And there's some redemption for VC here, where if you take this into account, VC appears to be a good hedge for post-crisis consumption shocks, and VC performance is really not as bad as the CAPM, this log CAPM that the GPME implies would suggest. And generally, you can think about other factors, right? There may be a liquidity premium. So there's some work on what might be the liquidity premium in private equity, because clearly this is a highly illiquid investment. you have to lock up your money for a very long period of time. Might not be quite as bad as you might think on first pass, because, well, the duration of kind of the money being out of your pocket as a PE fund is less than the fund life. Not all capital is called at inception. Most distributions come back well before the end of the fund life. So perhaps the average duration is maybe 5 years, 6 years, 7 years, rather than 10 to 15 years. And there's, of course, some self-selection by investors who invest in PE in the types of investors who can bear the illiquidity. So there's a number of papers that unfortunately I don't have time to talk about, but I'll just list here that you can look at that look at this liquidity issue. But I think there's a lot of work left to be done here, both empirically and theoretically, on figuring out exactly what is this liquidity premium. There's some sense that maybe idiosyncratic risk might matter. LPs may be well diversified, but GPs are not. And so they may care about idiosyncratic risk exposure. And this survey that I mentioned before actually asked about how VCs adjust for risk. It seems like, to the extent that they do, many of them adjust for all risks the same, whether it's systematic or idiosyncratic. And a fair number even adjust and discount idiosyncratic risk more than systematic risk. Right? So that clearly signals that idiosyncratic risk measure might actually matter here. And there's a paper by Ryan Peters that finds that shocks to idiosyncratic volatility do indeed seem to be priced in VC. So I think there's a lot of work left to be done on this dimension, and I hope we'll learn much more about in the future. There's some sense that term structure effects might matter. So there's a paper by Gupta and van Nieuwenburg that show that the term structure of interest rates is important. For example, the management fee that you pay every year is essentially like a short annuity bond. You know what you're going to pay every year. So then the term structure of interest rates is going to matter for how you value that short bond. And there may be other term structure exposures that you expose yourself to investing in private equity. They also look at other equity exposures like growth and value stocks and even REITs. So it's a very interesting paper. Methodologically, they make some interesting contribution. Instead of evaluating PE cash flows at the realized stochastic discount factor, like the generalized PME does, they use state prices. So they use strips that pay off, say, a dividend in a particular state of the world or in a particular time period. And that has some advantage in terms of avoiding estimating expectations over short time series and in small cross sections, basically avoiding some small sample period issues with SDF pricing. But of course, you don't get something for nothing. You do have to take into, you have to take more and have more assumptions and structure on the model in order to estimate the asset pricing model. So there's some trade-off there. Okay, so in the time that I have left, let me very quickly run through investment level data because I haven't looked at this, but I'm going to go really, really quickly and don't do this literature justice. And then kind of summarize some of the results that I think we have and some of the salient empirical evidence that I've sort of gleaned from the literature that we have. Okay, so very quickly, investment level data is an alternative to using fund level data, where we just drill down and sort of break open that black box of the fund and look at individual portfolio investments. So for VCs, that would be startup companies. We have financing round valuation, so we see that a particular startup is worth X at some time period, and then 2 years later they're worth, you know, Y dollars, right? And we can compute returns on that. And try and estimate factor models or compute TVPIs or IRRs or PMEs on those individual startup company investments. You can do something similar for buyouts, investments, etc. Common data sources are PitchBook, VentureSource, which was recently acquired by CB Insights, Crunchbase, and others. And you can, as I said, you can construct PE indexes from this, very much like a repeat sales index, like people do in real estate markets. So there's some examples of that in venture capital. Compute PMEs or other metrics. So the papers that I mentioned here compute either PMEs or generalized PMEs. And of course, estimate factor models. So there's a number of papers that explore different ways of estimating factor models on deal level, individual investment level data. There's some pros and cons to using investment level data. One big advantage is that you're now looking at gross of fee data. So we can actually estimate gross of fee returns, which gives us some more direct evidence on GP skill, right? Do GPs have actual alpha or not? Whereas if we look at fund level data, we're looking at net of fee data. Maybe the GPs soak up all the rents, all the alpha with fees, and on a net of fee basis, there's no alpha left. Doesn't mean there's no skill in GP. So this is basically the Burke and Green 2004 idea, right? That the fund manager will soak up all the rents with fees. So using net of fee data like we do in fund data doesn't give us a very direct view on whether there's any skill on the part of GPs. Investment level data would potentially allow us to do so. You can do much better sorts on industry, geography, etc. Since most private equity funds are somewhat of a mix of geographies and industries and etc. Using individual portfolio company data, we can get a much cleaner set of, okay, let's look at, I don't know, software investments in Austin over a particular period. What was the risk return kind of relation over that period? But there's also some cons, of course, and particularly for VC, we end up having to use post-money valuations, which aren't necessarily equal to market valuations. And we have some sample selection issues because we don't tend to observe a lot of firms that go bankrupt. So we tend to see the winners, but we tend to not see all of the losers. So there's some success bias in that data that you then have to deal with. And there's various papers that have tried to deal with this in various ways. So I'll skip through this because I'm pretty much out of time. There's a paper by myself and Morten Sørensen, as well as by John Cochran, that have looked at this issue where you basically take a factor model and you layer a selection equation on top that allows you to deal with this selection issue. And the upshot of this is that selection matters, right? The success bias clearly matters. Expected returns are extremely high if you just take the raw portfolio company level returns. They can be over 100% a year, which looks amazing, and beta estimates are really, really low. So this looks like an amazing investment. Once you correct for this selection bias, returns are still high, but it slices off about half of the return right there, both on an expected return basis and on a risk-adjusted return basis. Now, these returns still look pretty high. They tend to be concentrated in the late 1990s boom period. If you look at the post-2000 returns, they tend to be 0 or negative. And they tend to be concentrated in seed or early stage rounds, where there's not a lot of dollars invested, but the risk-adjusted returns are quite high. But the later stage rounds tend to have much lower risk-adjusted returns. Okay, so let me take the last couple of minutes I have left, well, last 2 minutes, I guess, in trying to put a couple of things together. Well, one thing that you'll find looking through this literature is that as of right now, risk and return estimates depend quite a bit on what data source you use. Not all data sources cover all of the industry. And it's better if you can combine a few of them because each sort of hits a different slice of the industry. It depends on sample period. It depends on empirical method used. If I put together the weight of empirical evidence in a CAPM kind of setting, the market beta of VC tends to be higher than the buyout beta. Gross of fee betas from portfolio level investments tend to be higher than net of fee betas. One reason for that is this profit share carried interest, where where basically carried interest is a short call from the LP's perspective. A short call option, which if you then take the net of fee beta estimates, you have to subtract the beta of that short call. So you get a lower beta estimate net of fees. And you sort of see that. This picture in the bottom shows you the distribution across different papers of beta estimates for VC and buyout. So if you look at VC from individual level investment, the median / average VC beta is somewhere around 1.75, 1.8. Net of fees, the median is a bit lower. The average is still around 1.8. Buyout gross of fees from, again, portfolio level data is quite high, much lower from fund level data. Okay. I have a review article that goes deeper into these various papers, but this is essentially the distribution across papers. In terms of other risk factors, VC tends to behave like small growth firms. Buyout tends to load on value, not in all papers, but predominantly. There seems to be some liquidity premium, modest, maybe 2 to 3% a year. The term structure of interest rates matters. There seems to be a role for idiosyncratic risk, but we need to know a lot more about that. There is some evidence of a PE-specific factor that unfortunately I didn't have time to get into, but here are some references of papers that suggest that there may be. In terms of risk-adjusted returns, VC gross of fee returns tend to be high in the seed stage and in the 1990s, but much lower, even zero or negative after, and outside of seed stages. Net of fees, high in 1990s by most metrics, zero or even negative in the 2000s. Buyout, generally positive before and after fees, but that's not true across the board, across all papers. Okay, so just to summarize and to conclude, I think we've made a lot of progress in understanding risk and return in PE over the last 20 years. There's still a lot to be done. So many open questions. I'll leave these up for you to read. With more data becoming available every day, and there still being many fruits, some of them low-hanging left on the tree, I think this is a very exciting area for future research. And I'll stick around to talk about anything you might want to talk about for the next 15, 20 minutes.
Wonderful. Thanks so much, Arthur. We will, as Arthur said, we'll stick around for a little while. I've put a couple links to registration for the next lecture by Song and the next seminar, which is next Monday. Take a look if you have the time, but we will post the video and Arthur's slides. I think we can do that, right, Arthur? Okay.
Absolutely. Yeah.
We'll post that on the website in the next few days. So if you had to step out and miss something, feel free to check the website. But thanks again for coming. I'll hopefully see you guys in the next couple of weeks over our lectures and seminars. Have a good rest of the week.